Welcome to the Planet MicroCap Showcase Virtual. I'm your host, Robert Kraft, and thank you all for joining us today. Now presenting at our event is Dominic Wells, CEO of Onfolio Holdings. It's a publicly traded company. The symbol is ONFO on NASDAQ. Dominic, take it away.
Thank you, Robert. Okay, so this is an investor presentation for Onfolio. Thank you, everybody, for your time. Necessary disclaimer. So I'm going to give you an overview of the company. We recently closed an IPO August 30. And before we IPO'd, we were founded in 2018. What we do is we acquire controlling interests in, and a lot of the time actively manage, websites, online businesses that operate in sectors with long-term growth opportunities, have positive and stable cash flows. So when we acquire them, they're already profitable. We're not kind of making seed investments. These businesses face minimal threats of technological or competitive obsolescence, and they can be managed by our existing team, or ideal situation, they already have strong management teams largely in place. Currently, we operate in a wide range of verticals. We're in pets, arts and crafts, B2B SEO services, health supplements, computers, graphic design, people search. And the types of businesses we have in these spaces vary as well. Some of them could be e-commerce. Some of them are publishing businesses such as a blog. Some of them are marketplaces, services, agencies. So the Onfolio business model is not based around success in a particular niche, but rather focusing on certain verticals and mediums where content, digital products, digital services have a key part to play. So it's all about our ability to find businesses that are already profitable. The founders or the sellers of the businesses maybe haven't fully utilized them, and we pay a price that, which I'll talk about in a further slide, but we pay a price that makes a lot of sense for us as well. And the key is our ability to do that and to take these businesses and grow them and reinvest the cash flows, rather than trying to build a kind of roll up around a certain space. Since we IPO'd, we've completed 3 acquisitions. One of them is another SEO service business, a series of WordPress plugins, and an online course business as well. So the kind of key point here is that through the acquisition and growth of a diversified group of websites, we offer investors an opportunity to diversify their own portfolio risk while taking advantage of the attractive, lucrative nature of online business. So a little bit of an overview of our strategy. As I mentioned, we acquire and operate profitable digital businesses. Our core competency is really finding these businesses where the sellers of the business can't fully maximize it. They're good businesses. Maybe they started out as side hustles or bootstrap businesses, something like that, and the seller's grown it to a certain size. Our target size is $1 to $5 million valuation, and then they kind of can't take it further, or they just decide they don't want to because they can get a, for them, life-changing amount of money by selling the business. We typically locate these opportunities through a robust collection of networks. We have relationships with brokers. We have people coming to us because we've got a strong reputation in the space. We're known for being quick to close and being fair as well. And yeah, so we then raise capital to accelerate our acquisitions. We received 12.1 million net proceeds in the August IPO. We've deployed over 5 million since the IPO to fund the 3 profitable acquisitions we mentioned on the previous slide. And we plan to use the remaining proceeds to fund future acquisitions. Then once the IPO proceeds are fully deployed with a little bit of a margin for working capital, we plan to raise non-dilutive financing, so traditional debt, preferred shares, non-convertible preferred shares, to finance and capitalize on additional opportunities, because we can typically purchase these businesses at attractive prices. Usually we pay no more than 4 times EBITDA. Sometimes it is more, but if the quality of the earnings is higher, then it justifies higher. But typically it's around there. Sometimes it's 3x. And that means that we can expect 25% cash ROI from these businesses without even growing them. And we do try and grow them as well. So when you are buying businesses for 20 and earning 25%, 20%, but your cost of capital, which we anticipate to be around 10%, maybe a little bit higher in 2023, maybe 12%, there's a pretty good margin there for financial leverage. And then how we scale it is we have a little bit of a decentralized approach. We did start out every business, but we were typically operating ourselves. That doesn't really scale very well. So now we are a lot more decentralized. And when we buy a business, we're thinking really of it as a standalone business. If we need to put a new CEO in place to run that business, we will. But the idea is we can scale through making lots of these acquisitions, and there's really an infinite amount of them. So some key investment highlights for potential shareholders. We're a highly qualified management team in place. The executive officers and senior management have approximately 70 years of combined experience. The company, we've assembled a senior management team with highly complementary skills, experience in the industry, accounting, finance, acquisitions, a lot of subject matter expertise with online business and the various different types of businesses. I think one of our key differentiators is that we have an ability to evaluate potential acquisitions. We believe we excel at finding acquisition opportunities where the seller has not fully optimized their business, but crucially where we believe the business is not going to die in a year or 2 years or 3 years' time. Our model is not around finding a business, doubling it, and then trying to flip that business for more money. It's around long, sustainable revenues that we can reinvest either back into the same company or elsewhere in our portfolio, either through making additional acquisitions or through just organic growth. As long as we don't have to deploy kind of risk capital on trying to grow a business, we will. Otherwise, we'll spend the money on just more additional acquisitions. We've got a track record of acquired company performance. We've seen annual profits of acquired companies increase by up to 300%. Obviously, that's the best case scenario. We really try to focus on buying a business where we can absolutely grow it, but if growth isn't on the cards, is this something which is a great business to own and we've paid a great price for it, or even a fair price? As I just mentioned, our business plan allows the profits to be easily reinvested. So we're buying businesses where they don't need us to keep throwing more and more cash after the business just to maintain its levels. We reinvest it throughout the portfolio, either again in the existing business or into other businesses or into acquisitions. And as we talked about as well, the management have relationships which offer opportunities. So we've got relationships with industry executives, investment bankers, commercial bankers. And I think something that is underestimated is how well known we are in the space. A lot of people who build the types of businesses that we like to buy, they're aware that we're a buyer and they want to sell to us because we have a reputation for being fair. We understand what's good about their business. We're not in the habit of lowballing. And what that means is that we just have the ability to get the better businesses that are for sale. So our acquire and grow strategy is to really combine the acquisition of businesses that complement our existing verticals, but also expand into other verticals where it makes sense. So, what that means is we've already got 3 SEO service businesses. If we find other businesses that complement them, such as marketing services or content creation services, then yeah, absolutely, that makes sense. There's going to be some synergies there. There's going to be some bolt-on opportunities, but that's not our core thesis. The core thesis is buy businesses that make sense, that are good businesses that we know we can cash flow profitably and use that to grow the portfolio. So it's a mixture of, yes, looking for synergies, but also just looking for good businesses that make sense. So some examples, they could be having a community around them, or content. If it's a content site, ideally the business has existing success with paid traffic. We don't want to be just relying on Google rankings. Attractive profit margins, cash flow with unleveraged marketing assets. So a lot of these businesses have huge email lists or customer lists, and the seller just isn't necessarily good at using all of those marketing assets. We like passionate, high value audiences or customer bases. We like the business to have a diversified traffic and revenue source. So again, we don't want something which it does well on TikTok and it makes one form of revenue, and it's a quote unquote online business, but it's not really diversified. It's not really a good acquisition target. Naturally, we want something with upwards growth trajectory in a growing industry or sector. We're not going to buy a DVD player blog, and again, where possible, proven track record with paid media, or a product with satisfied customers and brand equity. Now, not every acquisition has all of these traits. The more of these traits, the better. But as I mentioned earlier, our strength is our ability to look at every acquisition opportunity, weigh it up on its merits, and pull the trigger based on how comfortable we are and our ability to run the business, or the existing management team to run the business in a profitable way. A little bit about the executive team. Myself, Don Wells, the chief executive. We have Adam Trainer, our COO, Esby Van Heerden, our president, and Jack Hawkins, our CFO. And some corporate updates for you. So October 17th, we completed the acquisition of SEO Butler, which is the B2B SEO service business we mentioned. And Proofread Anywhere also closed on that day. This is a course business teaching people how to build a career online as a proofreader. And then on October 27th, we completed the acquisition of BWPS, which is 2 WordPress plugins: Prevent Direct Access and Password Protect WordPress. So a suite of WordPress plugins. Got our quarterly financial review here, and balance sheet and cash flow. And if you have any questions, you can contact Alex Thompson or Greg Robles, onfo@gatewayir.com. And yeah, there's a little bit of time left for some questions if there are any.
All right, Dominic, thank you very much for your presentation this morning. So we have a good amount of time for some questions here today. So my first question for you is what was the original thesis when starting the company? Was there a particular asset in mind that you were looking at? I'd love to hear more there.
Yeah, I mean, when we started out, my bread and butter and the bread and butter of our team was around what's known as a content website, which could be, think of it like a publishing business, like it just publishes content, could be information, could be reviews, and it's monetized through advertising or through commissions from product sales. And the idea was, there was kind of 2 things. First was I was quite good at spotting businesses for sale where the seller hadn't kind of pulled all the levers and done all the things that you can do to maximize the monetization. And then the other element of it was there's always an element of risk just having one online business, but if you have 4 or 5, then you're diversified. And so really it was, okay, how can we build a portfolio of these businesses where we can grow them as soon as we acquire them or shortly after acquiring them, but also kind of mitigate the risk of one of these businesses being knocked out by a Google update. As we got better at that, we realized content businesses are good, but they are a little bit too reliant on Google, and people have got a little bit better at optimizing their businesses before they sell them. So we started to build up kind of subject matter expertise and capabilities in other forms of business, such as e-commerce or services or courses and communities and so on. So it really just kind of expanded from there. But the core thesis, I guess, hasn't really changed. It's still, how do we find businesses where we can improve them, where we can certainly maintain them, and because of the prices we're paying, even if you maintain them, it's actually still a pretty good acquisition, and where we can diversify and scale. So yeah, it's kind of just evolved from there over the last 3 years.
My next question for you today, we're managing through tough markets right now. What measures is the company taking to manage some of these macroeconomic pressures that are currently affecting all microcap companies across the board, or most of them?
Yeah, I mean, there's a few things. For us, there's actually kind of as much opportunity as there is risk here, because we're in the business of buying businesses. And so when something is negative for businesses, that can be a positive for us, because it gives us the ability to maybe pay less than we would have a year ago for a business. But in terms of our own risk management, we're kind of asking ourselves, what happens if 60% of our revenues evaporate overnight? Or what happens if 80% evolves overnight? Or when we're looking at an acquisition, if we're looking at, for example, a marketing agency to acquire heading into a recession, or what most people believe is going to be a recession, and marketing agencies, typically they're a discretionary expense. They're one of the first things that get cut. So we're factoring that into our due diligence and perhaps into our offer, or maybe just passing on the business entirely. So it's a mixture of making sure we've got cash reserves. It's a mixture of planning for what happens if revenues evaporate. And when we're looking at due diligence, it's really, how are we going to, when we find a business, rather than hoping it's going to maintain or assuming it's going to maintain, we're kind of assuming it's going to decline in 2023 and making sure we act accordingly.
Very good. All right. So, from what you can tell us, looking ahead to 2023, what would you say are some of the company's value catalysts that you think folks should pay attention to?
I think, reaching the point where we've deployed the IPO proceeds is going to be pretty significant for people, because there's probably some question marks about when are Onfolio going to reach profitability. And we're targeting that when we've deployed the IPO proceeds, that's where we're going to be able to show that. So people should look out for that. And then, as I mentioned midway through the presentation, we'll be then looking to raise non-dilutive capital. So obviously there'll be a press release and an announcement around that. So that will be really, for us, that's kind of the next stage. Stage one, deploy the IPO proceeds, get to cash flow positive. Stage two, kind of rinse and repeat. So those are really the catalysts that people should look out for.
All right. Well, last question for you here today. You went over this a little bit in your presentation when you talked about your criteria when you're looking at potential acquisitions. I mean, in an ideal world, also from what you can tell us, what does that ideal acquisition look like right now? Like what do you have in the pipeline, and how competitive is it right now to close some of these deals?
Yeah, I'll start with the competitive nature. There's always other buyers in the space. So I don't want to say whether something's a seller's market or a buyer's market, because it's never really either or. But yeah, there's always other buyers. But we are in the space that we're playing, which is the kind of $1 to $5 million acquisition price. We're one of the better buyers out there, because a lot of other people who have the level of financing that we have are either buying much bigger businesses, or people who are looking at businesses our size, they're going to want to heavily try and get seller financing or an SBA loan or something, which most people don't want to deal with. So we are a preferential buyer for that reason. And in addition, our ability to kind of get deals done and actually execute and make the situation good for a seller is key. And then, what's an ideal acquisition for us? So, yeah, it's something where we feel, first of all, confident, or as confident as we can, that the business is still going to be around in many years to come. One where we feel confident that it's going to be around in a level that we're happy with. So sometimes businesses dip, sometimes they take a little time to get back up to speed, but something where we think, okay, yeah, this is going to continue to cash flow. We're not going to have to pour a ton of cash into it after we acquire it. And that usually means it's a business that has a strong brand or a strong reputation, or a good product. It has diversified forms of customer acquisition, forms of traffic, forms of monetization. And that really can apply to a number of businesses. It could be an agency, it could be some WordPress plugins. What's kind of interesting about WordPress plugins is they have a lot of the features of like software and SaaS products do: recurring revenue, not particularly cash intensive, very sticky customers. But unlike other software businesses, we don't have to pay like 7 times revenue to acquire those businesses. We're paying 3 or 4 times profit. So it's, you get one of the best types of earnings on the planet without having to pay the premium for it that you usually would. So that's an interesting area for us to explore. And then really it's just something where we say to ourselves, okay, how recession proof do we think this is? And then, that's kind of, that's definitely the top of our mind as well.
Very good. All right. Well, Dominic, thank you so much for your presentation today. Really do appreciate it. And to everybody listening and watching, thank you for participating, and thank you, and enjoy the rest of the event.
Thank you. Yeah, thanks for having me.